March 12, 2025, London. City traders arrived as usual, jackets pressed, coffee in hand, scrolling through headlines without much thought. It was just another Wednesday morning. Until it wasn't. At exactly 9:08 AM, the Financial Conduct Authority, FCA, dropped a statement that ripped through the UK financial world like a thunderclap. UK financial institutions may face up to £44 billion in compensation due to historical misconduct in car financing deals between 2010 and 2021. Within minutes, phones rang off their hooks, news stickers flashed red, major banking stocks fell by 7%, 9%, some as much as 13% in a single trading session. And on the floor of the London Stock Exchange, confusion gave way to panic. Executives cancelled launches. Lawyers were summoned, crisis teams activated. The shockwave wasn't confined to financial circles. Social media erupted. Every radio talk show, every pub conversation, every living room with a finance foxhole or piget turned to the same question. What did they do? The story begins more than a decade ago, in the early 2010s. When Britain was clawing its way out of the global financial crisis, car ownership had dipped, credit was tight, consumers were cautious. Then came the golden carrot. Personal contract purchase, PCP deals, with low deposits, fixed monthly payments, and the promise of upgrading to a new car every few years. PCPs were irresistible. Suddenly, average earners could drive Audis and BMWs they previously only admired from afar. Dealerships flourished. Car sales surged. Finance companies celebrated record earnings. But hidden within the small print was a mechanism few noticed. Discretionary Commission Arrangements, DCAs. Dealers were given the freedom to adjust interest rates on these finance deals. The higher the rate they set, the more commission they earned. The system incentivized overcharging in a way that was almost invisible to the average buyer. And the banks? They approved. They benefited. They looked the other way. For years, it worked. No one asked questions. The FCA issued mild warnings in 2017, but little action was followed. Then in January 2021, the regulator officially banned DCAs, calling them inherently unfair. Still, no retroactive investigation was launched. Why? The answer lies in a mix of industry lobbying and a cultural inclination to avoid rocking the financial boat. Car finance, after all, had become a staple of the consumer economy. Unraveling it risked economical consequences few were prepared to face. So the silence held. That is, until someone broke it. In late 2023, a digital envelope arrived at the inbox of a Guardian journalist. Inside, hundreds of internal emails, voice memos, and PowerPoint decks. A whistleblower from within a major high street bank had compiled damning evidence. Dealerships instructed to exploit DCAs, spreadsheet formulas showing how rates were manipulated. The documents painted a picture not of isolated incidents, but of an industry built on a quietly systematic abuse of trust. The Guardian held the story until it could be verified and legally protected. They worked with financial analysts and legal experts for months. Quietly, the FCA was informed. Investigations began to mount. Then in March 2025, the dam burst. The fallout was immediate and volcanic. Consumer advocacy groups called it the second PPI scandal, though many insisted it was worse. With payment protection insurance, the harm was abstract. People were paying hundreds, sometimes thousands, more than necessary, because a dealership had chosen to boost its commission. By the end of March, over 2.1 million complaints had been lodged. More than 40 law firms launched investigations. Major banks issued lukewarm statements. Santander to shut almost 100 branches after warnings it could quit Britain. The extraordinary proposal to abandon Britain was said to have been partially triggered by frustration over costly UK rules introduced in the wake of the financial crisis, leading to lower returns than in other markets. Santander has been forced to set aside £295 million to cover potential costs from the car finance scandal after a court ruling rattled the finance industry last year. When it came to Lloyds, they admitted reviewing historic practices. Lloyds and other lenders are currently embroiled in a Financial Conduct Authority (FCA) investigation into whether customers were aware of discretionary fee arrangements, where dealerships would receive higher commission if they sold loans to customers at higher interest rates. The city watchdog is concerned that this practice may have seen drivers mis-sold loans that were not in their best interests. Although the ruling is not directly tied to the FCA review, the outcome wiped more than £3 billion off Lloyds amid concerns that the UK banking industry could be on the hook for billions of pounds in customer compensation. Barclays said it would evaluate the implications of the FCA findings. Barclays, a well-known multinational bank headquartered in London, has expressed its plan to set aside £90 million as fund allocation for the potential Barclays finance claims related to the historical Motor Finance Commission practices in which they have been involved. The company has already disclosed this provision during their company's 2024 financial results, as it is their response to the ongoing car finance scandal. Translation: stall for time or hush money. Some analysis feared a domino effect. If banks were forced to set aside billions for compensation, lending would tighten, mortgages could become harder to secure, credit availability might shrink, the broader economy could slow. It wasn't just about car loans anymore, it was about faith in the financial system. In just a month difference, this drop is considered to possess a negative impact on the financial system of the United Kingdom. Why hadn't the FCA acted sooner? What did they know in 2021? And why didn't they investigate the past then? A parliamentary committee launched a rapid inquiry. Early testimonies hinted at internal memos warning of consumer exploitation as far back as 2015. Some whistleblowers claimed they were silenced with non-disclosure agreements and settlement packages. With mistrust at an all-time high, theories flourished. Some claimed the FCA has been pressured to delay announcements until after the 2024 general election. Others suspected certain car manufacturers had insider knowledge and began shifting to subscription models to avoid future scrutiny. One theory posted that the entire PCP structure was modeled on subprime lending tactics, an industry quietly repackaging risk and transferring it to consumers. As April dawned, the UK stood at a regulatory crossroads. Should the government mandate compensation or allow the banks to settle quietly? But who is eligible for compensation? The FCA estimates that around 40% of car deals may have been affected before 2021. There are two criteria you must meet to have a chance at receiving compensation. First, you must be complaining in relation to a finance deal on a motor vehicle, including cars, vans, motorbikes, and motorhomes, that was agreed before January 28, 2021. Second, you must have bought the vehicle through a mechanism like Personal Contract Purchase (PCP) or Hire Purchase (HP), which make up the majority of finance deals and means you own the vehicle at the end of the agreement. Drivers who lease a car through something like a personal contact hire, where you give the car back at the end of the lease, are not eligible. Supreme Court decisions can take anywhere from a few weeks to several months. While this case is likely to be done more quickly than usual due to its large scale and huge public impact, we still don't know exactly how long it will take. If it came out before the summer, that would be fast. Predictions on that verdict are many, but Martin Lewis, the MCI founder and chair, had three scenarios in mind. Most likely outcome: many expect the Supreme Court to overturn the Court of Appeal ruling on commission disclosure complaints. If that happens, then the redress scheme will only be set up for DCA complaints. Possible outcome: if the Supreme Court upholds the Court of Appeal ruling, then the FCA would set up a redress scheme for all car finance, while the 99% affected by this. Unlikely outcome, but not impossible. There is an outside chance that the Supreme Court will rule out the commission disclosure complaints and make a pronouncement within that which causes the regulators to rethink whether DCA complaints are justified. That could mean no redress at all, but I think this is pretty unlikely. In the end, the £44 billion figure may have been the starting point. The cost to reputation, trust, and financial stability could take a generation to repair. The car finance scandal of 2025 isn't just about shady interest rates. It's about the fragility of oversight, the quiet complicity of power, the system that allows everyday people to be misled with a smile and a signature. A reckoning has arrived, but whether it becomes a turning point or just another footnote in Britain's long history of financial scandal remains to be seen.